So hello, and I welcome you to today's weekly market outlook here together with Admiral Markets. My name is Jens Klatt, and I'm very happy to be here today. It's the first Friday of the month, and we have the non-farm payrolls ahead of us. Very interesting data set, which will be published here in around 1.5 hours. And sure, we want to look into the details around this and why this market or event could potentially be a market mover. Unfortunately, I just found out right now. I just found out that I have to look up here a screenshot I prepared for you, which is of high interest, in fact, regarding this news event. It's around the non-farm payrolls. But and this is the good thing about it. Before we start with this screenshot and the non-farm payrolls, a deeper look into not just today's events, but also in the events from the upcoming week, we have, as usual, have a look here into our risk disclaimer. Trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. This were only the first two sentences of the risk disclaimer. The full risk disclaimer can be viewed here, can be seen on or found on the website from Admiral Markets, admiralmarkets.com. If any questions arise around this, feel free to reach out to Admiral Markets directly, to their client support. We want, as usual, have a look nevertheless into the new regulation and the ESMA decision. I know it's already 1 year ago, and so far many have probably adapted already to the reduction in leverage. Still, we want to dig a little deeper into this topic here and what makes Admiral special in this context. The differentiation ESMA decision is now taking place between retail clients and professional clients. And what you see here is the leverage restriction for retail clients with a max of 1 to 30 from Forex majors and 1 to 20 for other currency pairs like Forex majors, EURUSD, $JPY. These are the currency pairs we are usually and mainly looking into here in this weekly market outlook. But from time to time, I also play around with some minor pairs like GBP Australian dollar, for example, or some might recall that last week we had a look at the very exotic currency pair. It's euro against Polish zloty. Some of you probably have followed the price action here. It wasn't really that huge, but still the setup played out well, and there were a few pips made on the downside here from a seasonal perspective. And yeah, then we have also the leverage restriction here on CFDs, on indices like DAX 30, but also gold. DAX 30 gold will also be in our focus today with the non-farm payrolls. And the differentiation between retail and professional clients now comes into play here, that a professional client can still use a leverage of up to 1 to 500. And the main topic here in this regard is the negative balance protection. So usually retail clients have, not usually, but they have an unlimited protection against negative balances, while usually professional clients have no such protection against negative balances. Case of Admiral Markets, the special thing here is that Admiral offers a negative balance protection of up to £50,000 sterling according to their policy. So if you plan to be recategorized as a professional client, first of all, please check out if you meet the criteria which has to be met here to be recategorized. Reach out to Admiral directly, to the customer support, and also if there are any questions regarding negative balance protection, what this means for you. This is me, the face to the voice you're currently listening to. And what's probably interesting about me is that I'm located in Berlin, in Germany. And Admiral has several offices around the globe. We'll have a look at this here in a few seconds. The interesting thing now, is that me being located in Berlin, where Admiral also has an office, is that in Germany, we usually refer to Admiral Markets to the so-called Dax Expert. So Admiral has a very, very competitive offering in regards to the DAX, with a typical spread of 0.8 points during the main trading hours. And what's even more interesting, especially for short-term traders, scalpers, for example, they have, with their offering Admiral Prime, they have a 0.2 spread in the DAX during the main trading hours. And in addition to that, you have a commission of 0.6. I'm sorry, 0.6 euro, yeah, but 60 cents. 60 cents per CFD then on top of that. So in addition to that, you come out at 0.8. Still with a tighter spread, it's probably very interesting for scalping traders here to have a deeper look into Admiral. While also on top of that, this has to be mentioned in this context, there's also very, very competitive offering, very attractive pricing when it comes to FX trading, for example. For further infos, please reach out to the website. Something I already mentioned here, the offices around the globe. So Germany was already mentioned with the office in Berlin, but there's also offices in Chile, for example, in Australia, for example, Admiral Markets Pty. What this could mean in regards to your trading or if you're listening from somewhere else around the globe, probably from Australia right now, yeah, be aware that there's also an office probably right around the corner. This is definitely something which is outstanding when it comes to FX brokerage, retail brokerage. I think in this industry, there are the contact details. I referred to this several times now. Feel free to reach out to Admiral directly. And now we want to look here at our agenda. Sure, it's a weekly market outlook, which means we will have a look at the upcoming week of trading with the key economic events. Still, the main focus today will surely be on the non-farm payrolls and how it could affect markets, especially Monday, where the economic docket is very, very thin. We also want to answer the question, what's the current bias in FX equity and commodity markets? So especially when looking at indices, for example, it becomes where it's really interesting to see that Donald Trump is somehow tweeting about every uptick the S&P makes right now, which is probably more and more a sign of markets overheating a little on the upside and probably a potential sentiment extreme, especially when looking at this quite impressive, let's call it, divergence between the S&P 500 performance while yields are dropping, 10-year US Treasury yields, for example. That's a sign that the overall trend currently in equities is up. Yes, still, there's a fear I have that we are probably about to see a deeper and more aggressive correction. And yeah, obviously, this is then the resulting question which we try to answer here, which trading opportunities may arise out of this. And now I see, you probably won't believe that, but it's really true. Shortly before I started this webinar, my computer just went down and I had to restart it. And now you might laugh, but the only app I forgot to open is the MetaTrader 5 from Admiral, which is not good. But no, not a problem. I can already take over then. It only takes a few seconds now till it's open. But what's probably very interesting for you, in the chat box, you can find a link. It's a new registration link for next week. So we are switching with the software we use here. So currently we're using GoToWebinar. But from next week onwards, we will use the so-called Zoom platform. Zoom has many, many benefits over GoToWebinar, and therefore, nevertheless, it's necessary that you register for this event. So probably you get a reminder next week that you get a reminder from GoToWebinar. Still, no one will be there because we are holding this webinar, the weekly market outlook, which we keep on holding at least for July. Next week, we have something really special. We will switch this format to another format, which is called Trading Spotlight. Every details will follow soon, and also a link for a registration. But next week here, this webinar, the weekly market outlook, will take place via Zoom. Everything stays the same, so you only need to register there. And yeah, please feel free to do so if you enjoy this format. And as promised, there we go. This is the MT5, which just opened, and now Here you can already see where some skepticism arises from. This is the DAX 30 on an hourly chart. Here we are about, well, not about, but we are definitely forming a so-called bearish divergence. It's only an indication, but this is a first sign which leaves me a little skeptical if there's so much further potential on the upside. It doesn't necessarily mean that we need to see a sharper decline here, a sharper break lower. Still, risk rewards for long engagements seem to somehow diminish a little. And this is definitely worth noting, especially in regards to today's non-farm payrolls. If these numbers disappoint today, I really could imagine the market coming down here, especially equity markets. So probably some of you recall that there has been a time when bad news was good news for equities, and that had to do with the fact that bad news usually meant nothing more than a more dovish approach, in this case then from the Federal Reserve, holding rates low while on the other hand keep on pumping money or liquidity into the market in terms of the QE program. So even though this is still true that here a more dovish approach might be around the corner, I more and more doubt that the overall reaction in equities especially will be bullish if non-farm payrolls disappoint. And the main reason for that is because there's more and more signs at the horizon which show a potential recession here, especially when looking at yields. And so some of you now might wonder, okay, why I'm skeptical around the non-farm payrolls today? Why should they disappoint? And there are several reasons for that. So first of all, so this is, by the way, here the economic calendar from Admiral Markets. You can find it on admiralmarkets.com, and then you go here to analytics and there to Forex calendar. And there you can see, you can obviously filter the economies you want to have a look at here. Look at the data range, and then you just apply this filter and you find out here that today there we have the non-farm payrolls with 160,000. I, by the way, have prepared already something where you can get an idea where this 160 come from. So this here is a chart which is from Bloomberg, and unfortunately it's a little small. I just had the chance here to snipe it out of an email I received, but I still hope that you can see what we have here. And let me just give you a quick explanation on what this is about here. So there you can see the median, the consensus, it's 160,000. So obviously the number here and the economic calendar from Admiral and here Bloomberg, these are identical numbers. So this is the forecast. So now the question is, nevertheless, where did these 160 come from? Is any primary dealer which is asked here, any analyst saying it's 160,000? No, this is not the case. In fact, what they do is they create such a chart here by counting all the analysts being asked and then saying, okay, so in this case, there's 12 analysts, for example, saying they expect the non-farm payrolls come in at around 150,000, plus minus 5,000. While, for example, here at this column, you can see if you go here to the left side, there is nine analysts being asked, and they say they expect the non-farm payrolls come in between 170,000 to 175,000. So they do nothing more than at those columns up here, respectively, make it that way, and then they overlay it with normal distribution. So and then you get here the highest point at around 160,000, and this is the number you get here as a forecast. So it's based on the input from analysts, and then via a statistical tool you get a number, you get a consensus. But what's more interesting, in fact, is this chart here perfectly shows what is the market expecting, and which number has to be published to create kind of a surprise in the market, and then a sharper reaction on the downside, respectively on the upside. And when looking here, you can see, okay, the consensus is 160,000. Still, the highest column is here to be found between or around 150,000. In my opinion, that means that the consensus is 160,000, but the analysts obviously expect a number which comes in below that, slightly below that, not that much, but still somewhere between 150 to 160,000. So that said, any number which will be published today below 150,000 is definitely something which can be considered a disappointment. So even if numbers come in, let's say at 155,000, markets will probably say, okay, that was expected. So there will be some sharper spikes on the upside, on the downside, and at the end of the day, we'll probably stay at the same level we started the NFPs from. And that's it. If we drop here below 150,000 and we get a reading similar to the disappointing reading we saw on here Wednesday with the ADP data set, and this is the website, it's some trading economics, and I highly recommend it, by the way, because it's completely for free. There's no advertisement on this website as far as I've seen it, and there's tons of fundamental data and statistics around such data sets like the ADP, like the non-farm payrolls. And so what you can see here is numbers on Wednesday came in at 102,000, which was significantly below expectation because numbers were expected to come in at 140,000. Still, they came in below that. 140,000 was already quite low compared to the consensus of the months before, if you have a look here. And they were also below the expectation from TE, which is trading economics in this case. So the TE forecast, they use their own models, and then they have here an expectation. And as you can see, based on that, numbers came in below expectation. What's even more interesting in this regard is the following, that small businesses with 1 to 19 employees, the numbers dropped a second month in a row. And usually this is also a sign which is pointing to a potential recession in the USA. So these numbers came in below expectation. In fact, there was not only a stagnation, but there was a drop. So there were small businesses going out of business. And in such an environment with not only yield curves inverting, especially in the US here, and the Fed becoming more and more dovish, especially with equity markets trading at all-time highs, as they currently do, Dow Jones, S&P 500, but also small businesses as a leading indicator, showing a tendency of more and more small businesses going out of business here. This is a clear sign that there's some, let's say, trouble around the corner, and the world is not as bright as Donald Trump tries to sell it to the whole wide world via his Twitter channel, where he's always pointing to the greatest economy ever due to his presidency and due to the fact that equity markets are going north and making all-time highs all the time. There's definitely some grain of salt to it, let's say. And so with this in mind, and especially when looking at the ADP data, we should be really careful of today's NFPs. And why is it noteworthy? It has to do with the fact, let me just here go to US. What you can do is you can overlay, you can compare this ADP data set with the non-farm payrolls. We did this already in the past, but the beautiful thing about this is you have now a quite interesting chart coming out here. So in blue, you have the ADP data set, and in black, the dotted black line, you can see that there's usually a high correlation. It's not set in stone, so sometimes there's a difference, there's divergence, but still, usually if numbers in blue disappoint, because they are usually published the Wednesday before non-farm payrolls will be published, if these data disappoint, then it's not uncommon to see non-farm payrolls disappoint too. And there have been also times in the past, nevertheless, it was the other way around. So ADP came in as expected, NFP disappointed, ADP disappointed, NFPs came out better than expected. Usually, nevertheless, there is a positive correlation to that, and that's one of the reasons why I'm very, very skeptical about the non-farm payrolls. And in combination, then let's come back here to the markets, and in this case to the DAX. In combination with this bearish divergence, I think we should be really careful because this is a potential trigger event. So far, volatility is very low, subdued, nothing really big. What we can see here, still there is a slight short tendency. That was also something I mentioned in the morning. So probably short setups should be favored. It's difficult to say, but you should nevertheless be careful of long engagements, let's say. And that was for two reasons. First of all, we traded below this blue line. This is the exponential moving average 50 on a 5-minute time frame. So, oh, by the way, this is the DAX 5-minute. Let me just see. Do I have a 5-minute here somewhere? Not sure. Okay. However, so it's a DAX on a 5-minute time frame, and usually this is my trend filter. So if we trade below, I prefer short engagements, while if we trade above, I prefer long engagements, and keep on preferring that till this picture changes. So sometimes this changes over the day. So we start below, but then break higher. This is usually a sign that probably the trend is about to change, and we have seen this also a dynamic support respective to the resistance line over the data. And so I think even though it looks a little coincidentally here, but what's very interesting is to see that if the market pushes back, it usually finds resistance here in this case then against this EMA 50 for whatever reason. I don't know, but I followed this for a long time now, and I've seen this plenty of times. It works especially extraordinarily well in trend markets. No surprise, it's a moving average, and still it's definitely something worth looking then for especially day traders and short-term traders. Yeah, in addition to that, we have the bearish divergence. So in the DAX, in this case, for today, with the non-farm payrolls, if they disappoint, I could imagine that if data disappoints, probably expectations around a more dovish stance from the Fed will probably increase, even though the overall outlook here is not that bright for equities then, and which means that a disappointing data set is likely to cause some headwinds for equities, and not only for the DAX, but I could also imagine that here for the S&P. Look at this very extended mode. Yesterday into the Independence Day, we tested 3,000 points here, a psychological very relevant level, and on top of that, we are also looking a little extended here on the upside, and something somehow tells me that probably the market is a little overheated, and it's not unlikely that we are probably to see a small bounce at least down to the breakout region, which is can be found around 2,950. I'm not saying it will happen today, but for the upcoming week, it's definitely something worth remembering, and that the risk rewards are getting a little unattractive on the upside. And we are mainly focusing on the DAX here in this case, but this is also something you can spot here. After we broke above 12,450 points, the market gapped higher due to the truce between the US and China at the G20 summit. Some of you probably remember last week's weekly market outlook. I said if there's some hint that there will be at least new negotiations, or negotiations resume, then we are likely to see at least a push on the upside. And yeah, in addition, with the Independence Day yesterday and the thinning out liquidity on Wednesday, already with the shortened trading hours, it didn't come as such a big surprise that the market, after it gapped above the new yearly highs in the case of the DAX, drifted really higher here. And still now the mode looks a little extended. On the other hand, once I have to say that even if you have the sign of a bearish divergence here, it doesn't necessarily mean that we are about to enter an aggressive down move. It could be that volatility stays subdued, that the market here corrects slightly, but still that this bearish divergence does not really come into play here. And on top of that, even if we drop, we can consider the picture to be bullish short term on the hourly DAX here, as long as we trade here above 12,480, 12,500 points. And even if we drop below that level, that's the next thing. Then we have the gap here on the downside, potential target on the downside. And yes, we probably close this gap, but still, I consider the picture really darken only if we drop below 12,400 points, and then I'm still not really motivated to take aggressive short engagements, because the overall picture stays at least neutral till we trade here above 12,200 points then. And so from a risk reward perspective right now, the picture is very difficult to trade. On one hand, we can say it doesn't look that promising on the upside, and risk rewards for long engagements in the DAX are somehow a little viewed, have to be viewed a little skeptical. On the other hand, I have to say, I'm not really confident that there will be a sharp correction and that risk reward on the downside is attractive too. So, and with this in mind, probably a conservative approach, even though it's a very conservative approach, but probably right now in the DAX, it's time to wait and just be patient and see in which direction things develop here. If this push lower happens, but we are not breaking below 12,500 points, and once this bearish divergence is not a topic anymore, I really have to say that then the picture changes, and with the DAX breaking above 12,600, 650 points again, further gains up to 12,850, 12,900 become likely. This is then something which is going with the overall advantage, which is still in play with higher highs and higher lows. So this is a clear long sequence. And also here on daily chart, you can see that the potential up to these levels this is definitely given. So probably this is the most interesting approach here, or even though it's a little conservative, it's definitely something worth looking for, because it's presenting itself in a clearer light. Let's say it's clearer if there's a push lower and we are not dropping below 12,500. It's a first bullish sign, and it perfectly fits the overall picture we have here, and then long engagement should be favored. So probably in the upcoming week we should definitely we should definitely look for long engagements instead of short engagements. Still, there's also another side to this coin, something I prepared. Let me just take out these charts here. So this is the Commitment of Traders report, and there we look at treasury yields. There's something really interesting. I already mentioned this last week, and the picture hasn't significantly changed. We still see a quite aggressive yield short position. I'm sorry, not, that's wrong. Yield long position, while we are short the T node in this case, that way around. So that means market participants, especially large speculators, are currently betting on yields keep on rising, which is surprising. If you look at the current environment in which we find ourselves, look at the Fed Watch tool at the end of the month, and this is probably the main driver for today, by the way. So if NFP data disappoints, then we're probably about to see a small positive development here from yield bears, let's call it. So probably that we are then going to somewhere around 30-35% here for a 50 basis point rate cut. So we can already see, nevertheless, and this is let's come back to the Commitment of Traders report first here. We can already see the market here when looking at the yields and at the future. We can see that the market is already expecting a rate cut by 100%. And that said, the question is only how high will the cut be, respectively, how low will they cut rates? Will it be 25 basis points or 50? The higher likelihood here is as 25 basis point cut. And that's due to mainly due to the comments from James Bullard last week on Tuesday, when he said that 50 basis point cut looks a little overdone to him, and he's a known dove in the Fed board. And so with that in mind, probably chances are really low. Still, you can see that markets are expecting, at least 1 out of 4 expecting, probably there will be such a 50 basis point cut. And this becomes especially true if today's NFP data disappoints. If the data disappoints, and now things are getting interesting, if data disappoints, probably yield traders then have to act. Finally, they have to react. And this is one of the reasons why today's NFPs should carefully watch. So I'd say with 60%, I'd consider the non-farm payrolls to be a non-event, especially if numbers come in somewhere between 160 to 180. If there's no big surprise in average hourly earnings, everything's cool. But if numbers disappoint and we are dropping significantly below 150,000, around the same range, where we come out at the same range, in the same range at the ADP on Wednesday, somewhere around 100,000, while there's also a drop in average hourly earnings. This short engagement here in the T-Note future, respectively, being long yields, is probably something which will be then which will then unwind. And yeah, with this in mind, we have to understand that if we get to see such a sharper squeeze on the upside in T-note futures, this is also something which will likely, very likely, affect markets like dollar JPY, gold, but probably also, usually this is a so-called risk-off move, affect equity markets. So you can see here that it's really playing together really well. The overall picture I've drawn for the DAX, and where bad news is not necessarily good news for equities, but in fact, due to this development here in the bond market, probably a disappointing data set will trigger a short squeeze here in T-note futures, which is then also likely to spill over to equity markets and result in a sharper drop then. And yeah, so with this in mind, there's also something worth mentioning here, which is something to remember for next week. It's a website here, Zero Hedge. Very interesting chart. It's already from Wednesday, but it perfectly illustrates that there's now a decoupling between yields and the S&P 500. So usually both these markets are positively correlated to each other, as you can see here. It has been the case in the past, and still has, where is the case here today, usually. But here now you can see there's a huge divergence taking place. And while the green line, the S&P, hit new all-time highs here, the 10-year yield dropped. So what I just presented on the commitment of traders report is nothing more than, in my opinion, if such a short squeeze happens, yields will drop even more, while then most likely the S&P will probably start a corrective move, not necessarily going south that way, but still start a deeper corrective move. So this is also something which you can probably then feel next week. So even though it's all speculative on what I just presented, I think there is some, from a technical side, there's definitely some arguments bulls like to hear from equity bulls like to hear. And so far, as low as volatility stays low and there's no big surprise in non-farm payrolls today, nothing to see here. And it's most likely that equities will probably drift higher. There will be a thin market environment. Everything's fine, even though it could be a very, very hot late summer then. Still, if the numbers come in today and they disappoint, then bond markets could definitely could result in some turmoil in markets, especially in the current very thin market environment in which we find ourselves in. And there are several indications, especially here, commitment of traders report, this chart. There are several reasons to be skeptical and to watch carefully what will happen. So probably it's a non-event. Then numbers come in as expected. Everything's cool. If numbers surprise, especially on the downside, which to some extent is not a big surprise at all, but still surprise in regards to what markets are expecting, then we could definitely get to see some bigger volatility. So yeah, so that's it on equity markets. Let's just switch over here then to the currency markets. Let's have a look here at EURUSD. Also very interesting. The drop in the euro we have seen after the very dovish Fed. In fact, yeah, it was a very dovish Fed. That's something we have definitely to say that way. We went towards and slightly above 114, and then from Monday onwards, we saw a sharper decline here, and now trading below 113 again. Disappointing NFPs probably could switch that picture, and we could then see probably Euro USD going back and closing the week also above 113. One main reason, nevertheless, or one question arises here: what's the reason for the drop in the euro? What just happened? There was something. This is something I will look at here in a few seconds when it comes to gold. Let me just see. Where is it? I think here. So this is my Twitter account, by the way. Let me just, oh, unfortunately, yeah. 1 second. Where do you have it? Usually I should have prepared it, but unfortunately it's not. Huh. 1 second. I know that it's somewhere here, but still I have to see. Let me just continue. Christine Lagarde was announced as a potential successor of Mario Draghi. Here, there we go. which comes as a surprise. Looking here at this headline from the Financial Times in September last year, it came as a big surprise. We have to say that because Christine Lagarde here said in September she rules herself out of race for top jobs in the EU. So she was not only here played as the head of the ECB president, but also that she will become the head here of the European Commission and replace Jean-Claude Juncker. So now, as it looks, European Commission, respectively, replacement for Jean-Claude Juncker will be another German politician. It's Ursula von der Leyen. But here, in regards to the European Central Bank, Christine Lagarde is a very, very interesting choice because she's known to be a super dove. So it's not only likely that she will continue with the policy from Mario Draghi, but it's also very likely that she probably will go even above that. Interesting enough, I'm not really seeing if this is only euro bearish and more dovishness as to be expected, because it can also create some kind of trust into the European currency, which means we all remember this famous Mario Draghi sentence in London in 2012 in July, when he said, "We will do whatever it takes." And this whatever it takes is something you should definitely expect from Lagarde as the managing director and chairwoman of the IMF here also. And so with this in mind, this could also be a positive sign for the euro, but all in all, markets are currently playing the dovishness. And remember, we were already referring to dropping yields in US dollar, or in USTs in this case, so below 2% again. So the US dollar from a yield perspective should definitely be considered not very positive, bearish in fact, while the euro really can't profit from it. And with that said, also, I haven't prepared the chart, but when looking at the Bund future, for example, so German Bund future, FGBL, you can see that the yield there hit the European the lower yield band at minus 40 basis points now, so minus 0.4%. And this is definitely something which is not only due to the expectation from Lagarde to be a super dove here, keep on being a super dove, but also surely recession fears, which are forming at the horizon. It's not only in the US, but also in the Eurozone and in general on the global economy. Probably likely because of the fears around the trade war escalation between the US and China. But still, I'm again not really confident if this is a sustainable move. I could really imagine that probably into the weekly close, if especially non-farm payrolls come out better than expected, there's a high chance that probably there will be a push higher in the euro against the US dollar, and we get to see at least a push back above 113. Still, especially after this performance over the last day, I really don't like to be long the euro here. That's definitely something I'd like to mention. If I want to short the US dollar, I definitely not take the euro here, but instead probably most likely take the very yield sensitive dollar JPY here. As you can see, so we have seen the push higher that was only at the first moment here was driven by the comments from Steven Mnuchin, the finance minister, yes, from the US, after he said that there's a higher likelihood, or that was interpreted from the market. So in fact, CNBC, the interview he gave here was misinterpreted. It was a interpretation of his rhetoric, that there's a very, very likely deal being found with China. And here, as you can see, especially after this truce was announced between the US and China at the G20 summit here, you can see that the momentum continued on the upside in dollar JPY because risk was not a topic, or in this case was a topic. Risk aversion was not a topic for a short period of time. Still, dollar JPY didn't make it above 108.70 to 109, so kept this sequence of falling highs and falling lows, which is definitely a bearish sign. And especially if this short squeeze happens, as I mentioned in USTs here, in US yields, 10-year yields dropping, if this really happens, then I think dollar JPY is a very good choice, and it's very likely that we go towards and below 106.70 to 107. And even, that's also something I'd like to say, even if we get, for example, today, surprising positive NFP data set, I don't really want to be long the US dollar against the JPY, even if the sequence here is broken with a push back above 108.70 to 109. But I probably carefully watch if this is probably an extension which is not justified on the upside, and then wait for potential reversals forming, which I then try to short, still with the target of dollar JPY going as low as 105. And another accelerator beside the yield markets is surely also the risk component here, especially if there's any new trade war escalation, any geopolitical tension building again between the Iran, for example, and the US. All this is potentially bearish for dollar JPY, because JPY usually profits here from an unwinding of current of carry trades. And then sure, also we have to have a look here at gold. And in fact, the picture I've just drawn for dollar JPY is completely the opposite, since there's a negative correlation, but still the same when it comes to gold. So gold has seen a push up to 1,440 USD again. That came as a surprise, and still I think the main reason for that can be found, can be found here when looking at this tweet from Donald Trump, where he announced, that was on Tuesday, that he's pleased to announce that it is his intention to nominate Judy Shelton as to be on the board of the Federal Reserve. Some of you probably do not know who Judy Shelton is, but Judy Shelton is first of all a critic of the Federal Reserve, and was also made some headlines when she said in, I'm not sure if it was 2019 at the beginning of this year or it was last year, but she was saying that she'd appreciate the monetary system going back to a gold standard, similar to Bretton Woods. And she was also saying that she'd really like to see that at Mar-a-Lago or something. This is the resort here from Donald Trump. So obviously she's also a Trump supporter. And so with this in mind, and let me just close this. So with this in mind, well, we have it here. It seems to make perfect sense that gold saw push higher, and again, anything which is yield negative, disappointing NFPs, short squeeze in yields, so meaning that bonds, T-notes especially, are aggressively bought back, is most likely positive for gold. On top of that, I'd probably like to mention also something else, a tweet I forgot to mention, and which is definitely something to take care of when looking, for example, at the euro in this case. There was another tweet from Trump which shows that even though I'm currently positive for the euro, especially due to the performance of the US dollar currently, especially from a yield perspective, we should nearly all the time be prepared to read something where Trump aggressively attacks Europe again from a trade perspective. So that was also a tweet here that was from Wednesday. China and Europe playing big currency manipulation game and pumping money into the system in order to compete with USA. We should match or continue being the dummies who sit back and politely blah, 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 blah. What he's doing here is he's aggressively proposing a devaluation of the US dollar. So he's aggressively going after that, and is really looking to somehow devalue the greenback in some way. And this is very interesting to note, because we should be aware that there will be, anytime there's a chance that Trump will aggressively go after the value of the US dollar, respectively announce something, especially on the Eurozone in regards to potential tariffs, which is aiming on the currency pair or currency market, currency pair, in this case Euro USD. On top of that, we should also remember this yeah, so far we haven't seen so much of news around this, especially in German media, which comes as a surprise. But last week, that was shortly before or around the G20 summit, I'm not sure, there was a news which said that the European Union is about to find a way to leave the US out of potential deals European Union can make with the Iran here, I'm not right. One second, I just have to see what's the word for umgehen. It's a German word. Let me just see. One second. Umgehen. To go around, yeah, why not? I mean, or bypass, yeah. So to go around the sanctions from the US against Iran here, and that's definitely something which Trump doesn't like to see here at all, and which is very likely to result in another round of tariffs. And any of such tariffs, announcements, whatever, is capable of pushing the euro lower, and this is also true especially for equity markets, sure, because it's another round of escalation. After now there is this truce between the US and China, and markets went to new highs. Now next round of tariffs against Europe especially would most likely result in a bigger drop in equities then, which is then, let's close the cycle here, positive for gold. Surely positive for gold, potential risk off move, potential yield drop, and then potential break above 1,440 USD, which is then pushing us or leveling the path up to 1,480 to 1,490 USD. Yes, and that's it from my end. So we have around 45 minutes to go till the non-farm payrolls. All I can say is take care and be aware of it. Volatility is potentially ahead of us, and I wish you all the best. Happy trading. Watch your stops. Talk to you again next week. Hopefully, again in the chat box. Please have a look here at this registration link for the weekly market outlook. We will hold in Zoom then, not in GoToWebinar anymore. But you need to register again, and I wish you a nice weekend. Happy trading, watch your stops, enjoy yourself, take care, talk to you next week. I look forward to it. See you, and bye-bye.